You know, for centuries, gold and silver have been seen as the ultimate safe havens, the places you run to when things get chaotic. But just recently, in a matter of hours, they went through one of the most dramatic price drops we've seen in decades. One minute they're hitting all-time highs, and the next they're in an absolute free fall. So what on earth just happened? Okay, let's dive into this. And just to get a sense of the scale here, take a look at these numbers. Gold was flying high, way up over $5,500 an ounce. Silver was topping 120. And then, bam, the crash. Silver just plummeted, down as much as 36% in a single day. For gold, it was the single worst day in over a decade. This was not some gentle correction. This was a shockwave.
So that brings us to the big question, right? The one we're here to answer. How could this possibly happen so fast? What could trigger such a violent reversal in two of the world's oldest, most stable assets?
Okay, so first, let's just frame this event. You have to understand, this wasn't some slow, gradual drift downward. No, this was like a tidal wave of selling that completely flipped market sentiment on its head, catching countless investors totally off guard. And, every tidal wave has a trigger, right? There's always an earthquake somewhere that sets the whole thing in motion. Well, in this case, that earthquake came from the institution at the very center of the global financial system, the U.S. Federal Reserve. A single piece of news was the catalyst for the entire collapse. And here it is. This was the trigger. The news that President Trump had nominated Kevin Warsh to be the new chair of the Federal Reserve. Now, I know what you might be thinking. A personnel change? Seriously, that's it? But in the world of high finance, who is leading the Fed it's everything. And here's why. It's because Warsh is seen as being hawkish. So what in the world does that mean? Well, think of it this way. A hawk is someone who wants to use higher interest rates to fight off inflation. They're the ones ready to take away the easy money punch bowl at the party. The market, though, was expecting a dove, someone who'd keep rates low and the party going. So this news was the exact opposite of what investors were positioned for.
And you can see the immediate impact right here. Before this news, everybody was betting on more easy money, more rate cuts, which is fantastic for assets like gold that don't pay you any interest. But after the news, the market instantly started pricing in the possibility of higher, or at least stickier, interest rates for longer. And precious metals were the first casualty of that sudden, massive shift.
But that Fed news, that was just the first domino to fall. Its impact created this powerful chain reaction that just rippled through the currency and bond markets, creating a perfect storm for gold and silver. Let's trace how this all played out.
Okay, so here's how it works. Step 1. The Fed signals it might get more hawkish. Step 2. That makes U.S. government bonds look more attractive, so their yields, the return you get, go up. Step 3. Those higher yields attract money from all over the world, which strengthens the U.S. dollar. And that leads to step 4. Because gold and silver are priced in dollars, a stronger dollar makes them more expensive for anyone holding other currencies. And that really hurts demand.
Let's break that down just a little more, because it's really important. You've got two big forces hitting at once here. First, that stronger dollar we just talked about. If you're sitting in Europe or Japan, an ounce of gold just got more expensive for you, so you might think twice about buying. And second, those higher bond yields create competition. Ask yourself, why would an investor hold a rock that pays zero interest when they can suddenly get a decent, pretty much risk-free return from a government bond? All of a sudden, gold's appeal starts to dim, instantly.
So we have our trigger, the Fed, and we have the immediate chain reaction. But that still doesn't quite explain the sheer violence of the crash. The truth is, the market was like a dry forest, and that Fed news was just the match. There were these underlying conditions that were just waiting to pour fuel on the fire.
And the biggest factor? Extreme positioning. Just look at this number. Silver had rallied over 40% in the year leading up to this. When you have gains that big, that fast, it means a ton of investors are just sitting on massive profits, looking for any reason to sell and lock them in. The Fed news was the perfect excuse.
And once that selling started, it just fed on itself. See, in trading, there are these key price levels called support. When the price breaks below one of those levels, it can trigger a wave of automatic sell orders from algorithms and traders. Selling becomes contagious. It stops being about fundamentals, it's just a mad rush for the exits, and that creates a nasty downward spiral.
This also helps explain why silver got hit so much harder than gold. It's because silver has this dual nature. Yeah, it's a precious metal, a store of value like gold, but it's also a critical industrial metal used in everything. So fears of higher rates can also signal a slowing economy, which hits industrial demand. Silver basically got a double whammy. It fell as a precious metal and as an industrial commodity.
And finally, we have to talk about the actual structure of modern markets. The rise of things like ETFs, exchange-traded funds, and the heavy use of leverage meant that a lot of people weren't holding physical metal. And this is so important because when prices fell, traders who had borrowed money to invest, that's leverage, they faced margin calls, which forced them to sell whether they wanted to or not. This forced liquidation acted like an accelerant, pushing prices down way faster and further than they might have otherwise.
Okay, so we've looked at the trigger, we've looked at the chain reaction, and we've looked at the fuel that was poured on the fire. Now, let's put all the pieces of this puzzle together and get the complete picture.
So the main takeaway here is that it wasn't just one thing. It was this perfect storm of 4 interconnected factors. First, you had the big shift in Fed policy uncertainty. Second, that caused a stronger dollar and higher bond yields. Third, you had massive profit-taking after that incredible rally. And fourth, you had the technical selling and market mechanics that turned a simple sell-off into a complete waterfall decline.
Ultimately, this whole event was just a powerful reminder of a fundamental market truth. When sentiment shifts, things can unravel incredibly fast. And precious metals, for all their reputation as safe havens, can be some of the most volatile assets on the planet in those moments. It's really a testament to how much power a single statement, or in this case, a single nomination, from a central bank holds over global markets.
Which, of course, leaves us with one final, pretty provocative question. Was this a short, sharp crash, a temporary panic before the trend just continues upward? Or was this the beginning of a much deeper, more painful correction for precious metals? The answer to that, well, that's what traders and investors all over the world are trying to figure out.